We do a week from Friday. And then we're going to go to chapter 10. And I'll explain why. We'll try to pick up chapter 4 later on. And here's why I'm doing this. Through years of experience, I've noticed that if you put chapter 4 right behind chapter 3, it gets confusing. It gets confusing because chapter 4 is basically the same as chapter 3, except it's when you own less than 100%, but more than 50%. So let's say you own 80% of the subsidiary. The journal entries are pretty much, the consolidating entries are pretty much the same. But there is an extra column put on for the non-controlling interest. So there's going to be 20% of the subsidiary, of the income goes to them, 20% of the dividends go to them, 20% of the equity section for the subsidiary goes to this non-controlling. Anyway, it gets confusing if you piggyback them right on each other. So what I'm going to do is we're going to go to chapter 10 and kind of stick that in the middle. Chapter 10 is, I think, the easiest of all of the chapters that we're going to cover. So anyway, long story short, I plan on us picking up to chapter 4. If we don't, it's not going to be the end of the world. The consolidating entries are basically the same. The only thing that changes is there's an extra column put on for non-controlling interest. But anyway, that's my reasoning to do it, just to kind of avoid confusion on it. All right, let's see here. All right, so today, by the way, I sent out 2 emails. I don't know what I was thinking. I didn't put the practice exam for chapter 3 on. But anyway, it's there now. So I thought we just kind of go through this, and this will be similar to what you'll get on your on the exam. Very similar to basically what we've been doing before. All right. Well, see if you can figure out what the goodwill is. I'm going to do something here. I'm going to move this down. Well, that's weird. Oh, I know why. It's centered. That's why. All right. And if you think you have it, let me know. So you can figure out how much the goodwill is. And you can put it in chat if you want. Anyone?
16,500.
Yes, 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 yes. Very good. Yeah, so here's the assets at fair value. This is what they're worth. These are the liabilities also at fair value. Liabilities usually are at fair value, just side note. So what are we getting that we can, I should say identifiable. Wait a minute, wait up here. Oops. Oh, how weird. I made it the same as the accounts payable. That's an unhappy coincidence, by the way. It didn't hit me till just now. Oops. All right. So this would be the net identifiable assets at fair value. 32. And we're going to compare that to the price that we paid. So this is put this in a little box here. So this is how much of the identifiable assets we got. We paid cash price paid was 48, and an unhappy coincidence that the accounts payable, I'll change that in the future, is the same as the Goodwill. All right, so the Goodwill, which is basically an unidentified asset. And again, there is no relationship between these two, between that accounts payable and this Goodwill. There's no relationship between them. I mean, I shouldn't say there's no relationship, but it's the dollar amount. You know, this could just as easily been 16, and this could have been 17. I will fix that in the future. Okay, so this is the Goodwill. Blue. Okay, well, let's start going through our. Oh, I didn't put the Sadie thing on here. I'm gonna write a note to myself to put Sadie on the test. I know you guys can copy and paste it in, you know, if you want, but I don't know. I just like having it. All right. You know what? I'm just gonna write it in. Okay, Sadie. Oops. Stockholders' equity, assets, dividends, income, expenses. Okay. So start with stockholders. Oops. That color. And then we got to come up here and take the retained earnings out up here. And this investment account, we have to get rid of this thing. Because this investment account is the same thing as bill. Now, this investment account is really bill company. Oops, so if we didn't get rid of it, we'd be counting bill twice. You know, this is this, this is in, this is this. So we're going to get rid of the bill investment because we're taking all Bill's stuff and putting it on the in with ours. Okay. Assets. This is the one that they goof up a lot. Wait a minute, I already got a color for assets. All right, so assets, we got the land and building, and we have to add these onto those 6,600 and 13,200. And the one that I always leave off. Wait, put it in a different spot. Goodwill is 16,500. If you ever don't balance, check the Goodwill. All right, dividends. Let's make those orange. Dividends are the kind of strange one. Well, first of all, I'm not in the right spot. Dividends are the kind of strange one because they are the only one that gets added to the investment, even though we're trying to get rid of it. All right, income. Make that green. And again, we're taking off the income because basically we're taking the Bill's income statement and including it with ours. So it will be counted in there. And last but not least, the expenses. Make those not sure what color that even is, but that color. Oh, I don't think I didn't calculate them, did I? Okay, 10-year life, same as before. So this is going to be additional expense. And the weird one about that, the E, is that it actually comes out of the asset. Because it's years gone by now, so this amount that we've increased it by, 1/10 of that is going away. And this, you keep making this journal entry for the next 10 years. At that point, you know, you can take all those off. There won't be any excess. You know, this will eventually have added up to the 13,200. So every year this is going to go down by 1320 every year for the next 10 years, and then eventually it'll be zero. All right, well, let's start moving stuff over. If we did this right, if I did this right, it should come out to be the same, and it is. So at that point, we say, woohoo. You don't need to put these in, but these would be zero. Okay. Retained earnings will disappear. The only thing that'll be left is 231,000. Net income from above. The only dividends, notice that these dividends were paid to Amy. Amy paid out dividends of 13,600. The only dividends that were paid to anybody outside of these two companies was the 39,600. So that is the only dividends we're going to count there. And again, these two should, very confusing making those the same color. Let's try to, there we go. Orange. Okay. Squashing the assets together. And you're going to add in any debits. There's no balance here, there's a debit. So you're going to add in any debits and subtract out any credits. And the investment account, you're going to add the debit, subtract out these credits, and that should be, hopefully it's 0. So it was a little nerve-wracking to, oh, I did this wrong. Hold on. Let's try that again. Plus. Hey. And you can actually check that number. Notice that the 507,4 540, these are exactly the same, right? They have to be for the balance sheet to balance. And so you say, okay, well, what's the only difference down here? Now down here, the only thing that gets left, the only thing that's different are these two, are the liabilities. These, the shareholders' equity, those all are gone. So these are only the two things that are left. So if you add this plus those two, it should come out to that. And let's see if that does work. Should, hopefully. So 507,540 plus 16,500 plus 42,900. Yep. I just proved to you that the balance sheet balances, so write that down. Okay. So these two are together. The only thing that is left from the equity section is going to be the parent companies. These are the only thing that are going to be left. The only. These are gone, these are gone. The retained earnings up here are completely gone. And those should balance, and they do. Question on that? Okay, I'm back. Questions? All right, that's not too bad, is it? Just like it's just like the ones in the handout. And just to kind of show you what would happen if we had the additional. If we had a non-controlling interest, there's going to be another column in here that says non-controlling interest, and it'll affect these totals some, but the entries are the same. Basically, what happens if you own the financial statements are consolidated based on control, and what I mean by that is even if you own, let's say you own 51%, you control 100% of the companies. Right? So you're going to put 100% of everything you control, the income statement, the balance sheet, all that kind of stuff. It all goes on at 100% because you control 100% of it. You don't own 100% of it, but you control 100% of it. So that goes on 100%, and then you back out for the non-controlling interest. So, if you had 51% of the company, then you back out 49% of the income. You'd back out 49% of the dividends. You back out, 49% of the equity. It's not. I mean, it's not terribly difficult, but it always gets to be confusing. Yeah, and so this is what the consolidations would look like. This is what would be shown for this. Well, that wouldn't be there. But so this would be what would be shown for the consolidated financial statements. The zeros wouldn't be there, obviously. Okay. All right. So I will be emailing the chapter 3 exam after class. It'll be due a week from Friday. Okay, so I'm going to start out with the chapter 10. Wrong. Okay. I should probably explain why we're looking at chapter 10 is for foreign currency translations. And you might wonder, well, why are we doing that? A lot of times you have when you do have consolidations, it's not uncommon to have a foreign subsidiary that is being consolidated. Now, they're going to be doing their transactions in their local currency. So whatever it is, in Europe it'd be the euros, or Britain would be the pound, and whatever. It'll be in their, in the local currency. And so what happens is you have to translate those so that you can add them in, because you're not going to have a financial statement that has mixed currencies. They all have to be either dollars or whatever. So to get them into dollars, we have to translate them. And there's a couple different ways that we do it. And it really depends on how integrated the operation is to the American or the US operations. And what I mean by that is, is it run as if it is integral, that immediately you change everything into dollars, or do you kind of let them go separately? Okay, yeah, you're making money and you're making it in pesos. We're not going to take any money out. You just keep running the business in pesos and let them go on their own. Now, if you say, okay, we're going to convert, whenever you make money, we're going to convert it into dollars and fold that money into our operations, then you have a different set of accounting rules. So there's definitely two different sets of accounting rules for it. One is when it's integral into your company, that you actually have the cash flows will be changed into US dollars and included in the cash flows for the business. Or the second one is when you just kind of let them go on their own and keep the local currency, do everything in the local currency. It doesn't get changed in US dollars. Now, there are reasons why sometimes you do this. For instance, changing it into US dollars. There are some countries that really don't have very good taxation systems. And so sometimes they have the governments that just print money. So that causes inflation. So a lot of times in some countries that, the minute you get dollars in the local currency, you try to change it into US dollars or something a little more stable. And so that's one of the common ways that they'll come about is that if you're in a country that has high inflation, you try to change it to US dollars. It could also go the other way. There's some countries that have very stable currencies, and there's no reason to put them into US dollars. And so it kind of goes both ways on that. All right. So let's take a look here. All right. So the first one is, hold on a second. Let me zoom here a little bit. The temporal method. And this is when you have a functional currency is the US dollar. In other words, you're going to change whatever income and cash flows that they get, you're going to change it into US dollar. It could be for any number of reasons. It could be that they have high inflation. It could be that you need the money. Sometimes the foreign subsidiary is making more money than the US one. So whatever it is, though, if the functional currency is US dollars, then that is the temporal method is one we're going to use. And gains and losses are reported in net income. Now the second one, the foreign currency rate method. Foreign operations are integrated into the local economy, not in the parent company. So the foreign operations, they're going to keep the foreign currency. They're going to operate it just like a regular company, but using the foreign currency. They're not going to translate it into US dollars. There won't be that back and forth translation coming through. But they're just going to keep it in the foreign currency. Oh, excuse me. Gains and losses are reported in comprehensive income. Have you guys talked about comprehensive income in your other classes? Is that you may have had it in a finance class, you may have had it in accounting classes. It's actually have you guys had anything with that or not? No, okay. Well, there's two ways that comprehensive income are a lot of times things that are a lot of times there are things that are transactions that have I don't want to say haven't occurred yet, but things that are more iffy, shall we say. A lot of times go through comprehensive income. And comprehensive income, when it was first when I first came up with it, it was supposed to replace net income. It really hasn't. But basically, you can do comprehensive income in two different ways. I'll put it here. Here, so we have net income. And we have revenues, we minus expenses. There's a few twists and turns here, but hey, oops. And we come up with our net income. So this is our normal income statement. Okay, comprehensive income.
Professor.
Yeah. You
I'm not sure. Yeah.
Sorry. I'm an idiot. All right. Yeah, so there's our income statement. Now, thank you for letting me know, by the way. All right, comprehensive income. There's two different ways you can do comprehensive income. You can either do a comprehensive income statement, where you have basically these same things. And you come up with a comprehensive income. So it's possible you have two different statements. It's also possible that you simply have comprehensive income items underneath the net income statement. And then come up with a comprehensive income. So it's a little bit unusual in that you get the choice basically of you can either do it this way, or you can just tack it on the bottom of the regular income statement. So sometimes it's people will have it as a completely separate statement. Sometimes they'll have it as a tack on the bottom of the income statement. But it's more, it has a lot more things in it that go into the income. And for instance, in this case, for us, gains and losses will go into the income. Yeah, somewhere down here, actually. Whereas comprehensive income will come down here. So if you're looking at the foreign currency rate method, these gains and losses will not affect your income. They'll affect your comprehensive income, but not your income. Gains and losses for the US dollar, the temporal method one, they'll affect both. Okay. Click on that. Okay, and here are the kind of rules for it down here. I'm not sure why these got why they put the income on the bottom, but that's what they did. But anyway, so we'll go through these and kind of see how they work out. It's not too hard. But again, the foreign currency method is when you keep it in the foreign currency, the US dollar method is when you translate it into US dollars, that it's integrated into dollars. Okay. So let's go to. Not a problem. It's not as hard as it sounds here. I'm gonna copy these over. Actually, I'm gonna do it a little differently. I'm gonna move the income statement to the top. This is the way you'll see it in the book, but I'm gonna move it to the top. Okay. Okay, so let's look at this. So problem one. The functional currency is in British pounds. So which method are we going to use? The temporal method or the current rate method?
Could you repeat the question?
Yeah, for problem number one, the functional currency is in British pounds. So that's gonna be the functional currency. So which
So it's the
method?
currency rate method then.
Correct. Yep. Yeah, so this is one we're looking at here because it's gonna be in British pounds, so this is gonna be the foreign currency method. So we come over here, now we know which one to use. Foreign currency method. In fact, I am going to hide this column so that we just see the foreign currency method. Okay. All right, the Becker Company is purchased on 1/1/21. Use this as the historical date. We'll get to that right here. This is a historical date. All amounts of British pounds, year ending, blah, blah, blah. Okay. And we have these pound to dollar exchange rates for different dates. The current one, now this is important, this is at year end. And the name current kind of sounds a little bit funny, but what they mean is like the last, what's the last current exchange rate basically for the year. And we had inventory historical average. And we have overall average. Okay. I think I got to show you something here before I get too far. Just so you know, the inventory at historical average is going to be here. It's going to be just plain old average for the foreign currency rate. Okay. So exchange rate for the income statement. Now you notice throughout the year, it's gonna be the average for the year. For the most stuff, anyways. So. You might be wondering, well, why is that? Well, the reason why it's average is that, you sell some stuff in January, February, March, April, you get the idea. It goes throughout the year. So the revenues, as long as they're coming in fairly evenly or close to it. Using the average, it makes all kinds of sense because it's gonna be the average of the exchange rate during the year. Okay. So what's gonna be the average exchange rate for this? What's the average?
Is it the last one there?
So this is gonna be our average sheet. So we're gonna take, I'm gonna bold these so we can see them. All right, so we're gonna multiply this first one. So 500,000 pounds, each pound on average translates into $1.25. Hey. Format those. Okay. And we're gonna do the same thing for most of these. Can you just copy this down? Yep. Actually, gross profit will calculate, for this one, it's not gonna matter. You could actually translate that and it should be the same. But it is possible your cost of goods sold could be different, so then operating expenses without depreciation. Average. Depreciation expenses. We averaged also. Now, we do have one that sticks out here. This gain of sale. Notice that this was at a specific date and time. So this one will not be at an average because it didn't happen throughout the year. This was a one-time thing. It looks like a gain on sale of equipment. And it happened on 4/30. So we are going to jump up here and take that. Oh, no, don't do that. And that's gonna be a plus, right? Because it's a gain. All right, so this should be our. Whoa, that can't be right. Oh, I know what I did wrong. Oopsie daisy. It's from the 137 down. There we go. So this will be our net income. Okay. Retained earnings. That's going to be a composite. Now, originally we just bought this company out on this date, on the 1st. So this is purchased on 1/1, so this must be from that date. Beginning retained earnings. Oops. So we are going to take the historical for this first one. Now, in the future, it's going to be composite, and I'll show you that it turns composite pretty quickly. Okay, net income from up here.
Here's a lie.
Dividends were paid on 9/1. That's a specific time. Can you see that? Let's change that color. Make it green. Okay, so the dividends were actually paid on a specific date. They were paid on it's not very, I guess you can't see that very well. We'll go a little darker on that. Okay, so we're going to take that specific date. Again, it's not a composite, that it was paid off at one time. So whenever you're given a specific date, if they give it to you, hopefully you should have an exchange rate for it. Okay, now you'll notice that when you go down here and you look at the retained earnings, it says composite. Well, you can kind of see that it's already getting to be a composite. Right when we get down to here, it becomes a composite. You'll notice that the net income had more than one exchange rate. The beginning had a different exchange rate. The dividends declared had so when they talk about composite, they mean that it has a bunch of different exchange rates in there. There is no one exchange rate. I mean, you could divide it, figure out an average for it, but there is no one exchange rate that you're going to directly. It's going to be a composite of different ones. In this case, it's 125, 122, 130, 126. Those all go into this. This is the composite number. And so that's what they're talking about. That's a composite. Okay. Now, balance sheet. You notice that this is made up at year end. And what do we use? We use the current amount. And so the year end, this is the current amount, and it's unfortunate they use the term current because that sounds like it means today, but that's what they use. Okay, so what is the current amount? Yep. Current amount at year end is 132. So that's basically what we're going to have all these at. And I am going to bold them so that we can see them. Okay. All right, liabilities, we do those at the current rates. Yes. No, I can't. I can copy this one. The stock section is going to be historical. So this common stock, so this is on 1/1/21, I forgot what color I made that. Orange, made that orange, all right. So 130. Hey. And the retained earnings is same as up here. Okay. Now, here's our total assets. And here is our total liabilities and equity. What immediately jumps out at you? From your first accounting class?
They don't equal.
Yeah, they don't balance. You go, okay, well, this is. It doesn't balance. 640 versus 632. Okay, well. We're gonna have a translation gain or loss. Now let's just figure out what the difference is here, and then we'll talk about whether it's a gain or a loss. So you have 640,000 in assets, 632,000 in change in liabilities. So the difference between those two is 7,550. Okay, now we're gonna see if this is a gain or a loss. So this, if you have more assets than you have liabilities and equity. So you have more assets. Basically than what you owe. Is that gonna be a gain or a loss?
Gain.
Yep. Very good. Yeah, gain, assets are greater than. Now, in the book, they will show you a very, there's nothing wrong with it. It's comprehensive, a way of showing you how to come up with this gain or loss. But quite honestly, you can just get this from doing the financial statement. You know, you don't really need to do anything extra to get there. I mean, you know, it'll take into account everything that happened in there and why it's different, but quite honestly, if you just go through, coming on to the end, compare your assets to your liabilities and equity. And yeah. If your assets are bigger than your equity, it's gonna be a gain. If it's less, it'll be a loss. Far away, I guess. Get a little closer. Okay. Any question on that? Let's take a break. Let's see. I'll be back at 7:15, say.
Just one note. Gosh. Okay. He's gonna definitely. You're gonna go keep.
Okay, so here's what we're gonna do. We're gonna do one more of these. No, then we'll call it a night. But I want to do the same, using the same the current rate method. So we're gonna jump to problem 3, which is basically an identical type of problem. And this is a functional currency is British pound. So we use foreign currency. I said, okay. So income statement, most of the stuff is going to go on at average, unless there's still have another specific transaction here, but basically it's going to go on at average because you just make sales throughout average throughout the year. You know, I'm gonna bold this whole thing. Oops. Okay, yeah, so most of the stuff's gonna go on at average. Now, this gain was on a specific date, so we are going to make an exception here. Because this was not throughout the year, this happened when we made the sale on 6/22. And that will be a plus, right? Yep. I got this little dog that I got a couple little dogs that are they're little rescue dogs. But the one dog, it happens every time. The neighbor has this pit bull, this female pit bull. It's like ferocious. It doesn't even bark. It like roars. You know, this only is going to kill you. Anyway, it really likes this little Chihuahua mix that I have. This little male chihuahua, and so whenever he comes out there, she rolls on her back and starts crying. It's the strangest thing. I think whatever it is, she likes it. So even though he's not very tough, you don't want to mess with him because his girlfriend is. I swear to God, her head is square. I mean, it's just terrifying. Okay. So this is our net income. Retained earnings, again, just like before, this is the you go back to the historical rate for that. And by the way, I should say something about the historical rates on these. You go back to whenever the original transaction happened, when you're going through these. So it's not uncommon to have, for some things, you may have historical rates that go back 20 years. Okay. So historical rate is going to be dividends declared on 10/31. On 10/31, those with the exchange rate was $1.29. Let's make that blue. And so this is the composite rate. And again, the composite just means is made up of a bunch of different rates. And you can already see that, 128, 125, 133, 129, this is just the first year. So going into the second year and third year, whatever, the composite rate is gonna be made up of a bunch of different rates. Okay, getting to the assets. Pretty much everything goes on at the current rate. So current rate is $1.35.
Go.
Uh-oh. Oh, I need to copy this down. Okay, so total assets. We'll use a current rate for the liabilities also. Common stock, we go back to the historical rates. Here. Okay, so common stock, the historical rate, I forgot already, was $1.33. Retained earnings, so remember that is a. Let's highlight. That is a composite rate. So it's just gonna be whatever we have for it up here. You can figure out what it was on average for the composite, but it's gonna change year to year and it's not gonna be really a meaningful number. Okay. So. Again, we have a mismatch. Oops, a little too dark. Between our total assets and our total liabilities. We have a difference of 12,080. And is that going to be a gain or a loss?
Gain.
Yep. It's going to be gain. Here's a CPA type question. How much is it going to change your income? It's not. The current rate method does not go into your income statement. It goes in comprehensive income. So it will not, even though it's a gain, it's not going to change your net income. It'll change your comprehensive income, but not the net income. Oh, I didn't write that in. It's a gain. Hold on. Yeah, it's a gain. We have more assets than we have liabilities and equity. This is the dollar amount of what we have. This is the dollar amount of what we owe to shareholders and to creditors. So we have a gain of that. And by the way, it's not unusual in these comprehensive incomes to have things reverse out. So you could have going from one year to the next, you could have a gain, you could have a loss in this. And it's not that they didn't happen, it's just that kind of like the wheel still in spin, the transaction, the ownership of this company has not ended. So, whatever the ending, the final tally is going to change from year to year. All right, that's probably enough of that. So I'm gonna send out the exam, look for me in your email, the chapter 3 exam. And yeah, let's see. Oh, and you can turn it, there's also a place for the practice exam that we just did, so make sure you get that in. We just did it, you already have it done. And then the chapter 1, what the heck? Let me change that. That's a little confusing. Okay. Any question on that? All right. Well. So have a good evening. Look for the chapter 3 exam. It should be coming in your email shortly. And we'll pick up chapter 10 again next week. Any questions? Okay, look at that. Over a half hour early. See?
Thank you, Professor.
Thanks, guys. See ya.
Have a good night.
Have a-
You too.